Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for the segment, we have Roosevelt Bowman, Senior Investment Strategist at Bernstein Private Wealth Management, to discuss changes around investor sentiment to take on risk in their portfolios. Roosevelt, it's great to have you with us. Welcome to Trade Talks.
Thank you so much, Jill. I appreciate it.
And let's start with the macro here for a moment. What's your latest take on the markets following what we've seen in the banking sector?
Yeah, interestingly enough, Jill, when we look at what's happened over the past couple of weeks, it's been the opposite of what you might expect. You've seen credit tightening for sure. The Federal Reserve Senior Loan Officer Survey mentioned that and showed that kind of pulling back of availability of credit. But interestingly enough, volatility markets across the board have kind of come down, right? So not only realized volatility in terms of how much prices are really moving, but even those looking to protect against large moves, how much they're paying for options, implied volatility, that's actually fallen sharply as well. So a little bit of the opposite of what you might anticipate and expect, but that's really, there has been some calming in the market across the board.
What changes are you seeing around investor sentiment to take on risk in their portfolios?
Interestingly enough, it's still kind of a situation where investors are cautious. Even though volatility has come back, you're still seeing tremendous amounts of money in money markets. Investors are kind of staying to the sidelines. Concerns about the debt ceiling and potential economic slowing are keeping people from investing a lot more than you would expect.
What sectors and asset classes are you keeping an eye on? In other words, which are taking the biggest hits from the crisis and which have the most opportunity?
Yeah, certainly sometimes it's one and the same. When you look at regional banks, they remain under pressure. If you look at some of the smaller banks, I would call microcap banks that are only about 1 to 2 billion in size, they've also been kind of dragged under by the regional banking stress, even though they have very different business models. They don't have the commercial real estate exposure. Their depositor base is a lot more diverse. Most of the money in terms of average deposits is actually much smaller, and it's below the $250,000 FDIC limit. So not really impacted by that potential deposit flight, but their prices have come down. So those microcap banks really do offer some nice opportunity.
Can you take us through your expectations for this week's FOMC Minutes release?
Sure. So I think the minutes will be in high focus, right? It probably will show a bit more debate that we haven't seen in a little while from the FOMC. If you look at the last 18 months, the communication has stayed pretty much in line. First, the committee members were expecting inflation to be transitory. They realized that was wrong, and they moved to a much more hawkish stance. I think the minutes, and more importantly, some of the recent commentary from Fed officials, both governors and presidents, have been speaking to the idea of potentially having to do a little bit more. So others have talked about looking to pause. So I think the minutes will be important, but I would argue the communication since the meeting and some of the more recent comments that show a bit of more dispersion of views is even more important. I think it does kind of lift interest rate volatility over the near term.
So then what are your expectations for markets through the remainder of the year? Are rate hikes from the Fed coming to an end?
Our view is exactly that the Fed is near the end, whether it's maybe one more or really staying at 525, we're probably at the end of the Fed tightening cycle. I think where we disagree with the market is we're not expecting large cuts. Inflation is simply too high and is unlikely to come down at the pace that would allow big time accommodation from the Fed. So we do think they hold rates right around these levels kind of throughout the end of the year. It's the kind of move down in inflation that we're anticipating, again, where we differ from the market, is that it's going to be a choppier experience. It's not going to be this smooth move down to the Fed's 2% target anytime soon. And therefore, that will not allow policymakers to cut in the aggressive fashion that interest rate markets are currently anticipating.
What other unique indicators and data points are you looking at as it relates to your market expectations and outlook?
Certainly. I think looking at some of the high frequency unstructured data, if you would call it, is really important. So online job postings, they've come off pretty sharply. They're down probably 11% over a month and down almost 32% year over year. So that kind of demand for labor, despite the fact that some of the current data in terms of non-farm payrolls and some of the wage data shows strength in the labor market, when we look at some of those forward-looking indicators, it's starting to show some kind of pulling back in demand. Same thing with the small business survey. When you look at that small business survey, some of the weakness in this past month is different than what we've observed before. We're seeing more concern from small businesses, not about the ability to find labor, which was their chief challenge, 12 to 18 months ago, but now they're concerned simply with demand for their goods. I think that's an interesting point that's kind of flown under the radar, that it's less about their supply of labor, more about people literally pulling back on their consumption.
And finally, Roosevelt, what keeps you up at night? How are you navigating these conversations with clients?
Yeah, certainly. I mean, I think what keeps me up at night is something that's, important and kind of on the minds of all clients, right? Geopolitical issues, hard to handicap, whether you're talking about any sort of potential trade deterioration or, oh, goodness forbid, a military conflict. That's what I think is certainly top of mind. Some of the other issues that clients are concerned about, I think will be resolved. You think about the debt ceiling. I do think that ultimately their incentives are aligned to avoid a default. That would really hurt investors and, quite frankly, donors on both sides of the aisle, and that's not something that's appealing. So I would say geopolitical issues for me probably keep me up at night more than some of the debt ceiling concerns.
All right, Roosevelt, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.